This is our second lesson, national income. In this lesson, we'll be learning to understand the meaning of national income and some basic concepts of national income. And also, we'll be knowing the various methods which are helpful for calculating national income. First of all, let's learn the meaning of national income in this chapter. So, national income is the measure of the economic activities of a nation. So, it serves as an instrument of economic planning. It denotes the purchasing power of the country. The whole country's income is being calculated. So, growth of a nation is measured by the rate of national income. So, it provides a measure for economic activities in the nation. Nobel laureate Simon Kuznets was the first who introduced the concept of national income. Let's learn the meaning of national income. National income means the total money value of all final goods and services produced in a country during a particular period of time. So it means the total money in terms of money, the total money earned in a country in terms of money. For example, like cloths in meter, petrol in liters, sugar in kilos. So it is the sum of all final goods and services in terms of money produced in a country for a particular period of time. So it can be calculated for 1 year. Let's see the definition which is given by Alfred Marshall. The labor and capital of a country acting on its natural resources produce annually a certain net aggregate of commodities, material and immaterial, including services of all kinds. This is the true net annual income or service of a country or national dividend. In this definition, the word net refers to the deduction from the gross national income in respect of depreciation and wearing out of machines, and to this must be added income from abroad. The basic concepts of national incomes are given below: GDP, GNP, NNP at factor cost, personal income, disposable income, per capita income, real income and GDP Deflator. See, these following are some of the concepts which is used for measuring national income. Now let's learn each and every concept one by one. The first one is GDP. GDP is the total market value of final goods and services produced within the country during a year. So this is calculated at market price, as we call it as GDP at market price. So GDP by the expenditure method at market price is equal to C plus I plus G plus X minus M. So let's learn the abbreviation. C is consumption goods, I is investment goods, G is government expenditure, X is export, M is import. X minus M is the net export, which can be positive or negative. So GDP is the total value of all the goods and services within the country, within the domestic territory of a country during an accounting year. The second one is NDP. NDP is nothing but it is the value of net output of a economy during a year. Some of the country's capital equipment wear and tear or depreciation or becomes outdated every year during the production process. So that is being deducted. So NDP is equal to GDP minus depreciation. So NDP is calculated as GDP minus depreciation. The next one is GNP, that is Gross National Product. It is the flow of goods and services at market value resulting from current production during a year in a current country. So it includes net income from abroad. So GNP includes 4 types of goods and services. Let's learn one by one. It can be like consumer goods and services to satisfy the immediate wants of the consumer. Second one, it can be the gross private domestic investment in capital good consisting of fixed capital formation. Third one is goods and services produced by the government, and fourth one is net export of goods and services. The difference between the value of export and import of goods and services is called to be net export. So it is also known as net income from abroad. So in this concept, the GNP, there are certain factors that has to be taken under consideration. Like the GNP is a measure of money in all kinds of goods and services produced in a country during a year in terms of money. Okay, wow? So that is called to be GNP. But in the manner due to the increase or decrease in the price, if sometimes there will be a change in the price, the GNP shows a rise or decline which may not be real. So these and all are accumulated and calculated under GNP. So the formula to calculate GNP is GDP at market price plus net factor income from abroad. Okay. Next one is net national product, that is NNP at market price. So NNP at market price refers to the value of net output of an economy during a year. So NNP is obtained by deducting the value of depreciation or replacement allowance of capital assets from the GNP. So it is expressed as NNP is equal to GNP minus depreciation allowance. So depreciation allowance is it is also called to be capital consumption allowance. The next one is NNP at factor cost. So NNP refers to the market value of all goods and services of output, whereas NNP at factor cost is the total of income payment made to factors of production. So here we say that NNP at factor cost is the net output evaluated at factor price. So it is it includes income earned by factors of production through participations in the productions process such as wages and salaries, rent, profit, etc. So it's also called as national income. This measure differs from NNP at market price in that indirect taxes are also deducted and subsidies are also added to NNP. So NNP at market price, in order to arrive at NNP at market price, it includes it excludes indirect tax and includes subsidies. So the formula to calculate NNP at factor cost is equal to NNP at market price minus indirect taxes plus subsidies. Personal income. Personal income is the total income received by the individual of a country from all sources before payment of direct taxes in a year. Personal income is never equal to the national income. Why it is not equal to the national income? Because the former includes the transfer payment, whereas it is not included in the national income. See, transfer payments like profit, taxes, employees' contribution, social security schemes, all these are transfer payments which are not included in the national income. So, but in business and government transfer payments from abroad in the form of gifts and remittance, windfall gains, all these are the sources of income for an individual which are also added in the national income. So the national personal income can be calculated as personal income is equal to national income minus all those transfer payments. What are they? Social security contributions and undistributed profit plus transfer payments. All these can help us to find out personal income. The next one is disposable income. See, disposable income is also known as disposable personal income. So already we learned personal income, yeah. So along with that, personal disposable income is also included. So it is an individual's income after the payment of income tax. So you have to keep it in your mind. It is the individual's income after the payment of income tax. This amount which is available for the household for consumption is called to be disposable income. Now, the whole of personal income cannot be spent for consumption because it is an income that occurs from direct taxes which has actually paid. Therefore, in order to obtain disposable income, direct taxes are deducted from where? Personal income. So hence it becomes disposable income. So disposable income is equal to personal income minus direct tax. So only one point you have to keep it in your mind. You have to deduct direct taxes from your personal income, which will become disposable income. The next one is per capita income. Per capita income, it is very easy. The average income of a person of a country in a particular year is called to be per capita income. Per capita income is obtained by dividing national income by population. So it is nothing but the average income of a people of a country in a particular year is called to be per capita income for that year. That's it. Okay. Next one is real income. Nominal income is national income expressed in terms of general price level of a particular year. Okay. So it is expressed in terms of general price level of a particular year in a given period of time. So real income is nothing but the buying power of nominal income. National income is the final value of goods and services produced and expressed in terms of money at current prices, but it does not indicate the real state of the economy. The real income is derived as national income at constant price is equal to national income at current price divided by price index during current year by price index during base year. Okay, so it is calculated with the base year and the current year. Current year is a present new year, base year is the previous year. Okay, so the current year is a nominal income, base year is the real income. The next one is GDP Deflator. GDP Deflator is the index of price changes of goods and services included in GDP. So what is it? It is the index of price changes of goods and services. So it is a price index which is calculated by dividing the nominal GDP. What is nominal GDP? Current market price, the price of the current market price level which is given in a year by the real GDP for the same year and multiplying it by 100. So GDP deflator is equal to nominal GDP by real GDP. That is a change in the price, okay, into 100.